Good afternoon, everybody. It is Monday, November 8th. This is Stocks of the Week, and we're going to go through some things very fast. And then I'll take a couple questions and answers. We're not going to be doing a retirement income options today. If you have questions, ask during this call. There's just nothing out there that I see that I just want to dive into too hard, given that this market started off pretty well today, and suddenly it's not feeling like it's all that excited anymore. I've been following the chatter on Twitter and Reddit. And as I suggested a year ago, a little over a year ago, the millennials are learning how to bet against stocks and against the stock market. So you really have to use the volatility to your advantage. And there's two ways to do that. You can take part in the trades that they're making because they are the ones pushing things, or you can wait for them to spike certain things that you already own and trim into their hypermania, or you wait for them to beat something up, or the hedge funds to beat something up. And then when something's heavily shorted, if you like it, buy it, and then hodl it. Now hold it, hodl it. That's the new way to do things. Hodl. And just let it go up. There are a lot of small caps out there that, as I talked about for 4 or 5 months, just weren't getting any love. And now they're starting to get some love. If you've been with me long enough, you know that I tend to be out in front. And then it's just a matter of making the trade when you find the opportunity. Ford, that's one of them that's become apparent to people. MP Materials, it's a pretty long list. Ginkgo Bioworks. You're taking a look at some of these Opendoor, Palantir, SunPower. Those are the ones that have already gone. And there's other ones that we own: Viacom, AT&T, Stone. You just go right through the list. They haven't moved yet. That's life. But if you can hold those and wait for the market to come through your position, you can do very, very well. And some of these are value stocks. AT&T and Viacom are value stocks. Other ones just have the potential to 5 or 10x or more. I think that On Track from here clearly is a 10x opportunity to me. Their addressable market is just gargantuan. Think about the unmet medical need for mental health care in this country. It's at least 100 million people that probably need some form of services, but between stigmatizing it and making it expensive, they don't get the maintenance or the help, the guidance that they need. And On Track addresses the stigma and the cost, makes it much cheaper, and it's more, I guess it would be less personal, right? You don't have to go to an office, sit in front of somebody. You can do it from your computer, from your own home, your own comfort zone. So I see On Track with their government contracts and their new CEO, who is a CVS guy. I think that they're going to grow a lot. And I think there's a very good possibility they get bought out, possibly by CVS. That would make a lot of sense. It integrates the pharmaceutical needs. And you've already seen them do that with clinics. So we'll see. But I think On Track either screams higher and screams higher again after that, or screams higher and gets bought. So if you're not in On Track, understand it is heavily shorted right now. It is a company that has contracts, has revenue, has growth. It just got ahead of itself, crashed. The momentum players pushed it further down. It's got about a 40% short interest right now. And the kids on Twitter and Reddit are saying, hey, maybe we should push this one back up to 30, 40, or 50. And when they say things like that, they mean it. And then they gang up and they do it. So on these low float stocks, right, when there's not a lot of stock that needs to be bought to push it up, they buy calls. That makes the market maker have to buy stock to hedge his position. And it just becomes a spiral upward. What's the most famous example of that? It's Tesla. So Tesla spiraled up whatever it was in the last few months, 40%, for no apparent reason. It's already valued more than the rest of the entire car industry combined for no apparent reason. They have 2% of the sales. And even if that grows to 10%, which I think it will, still overvalued by quadruple. So the power of leveraging up your money to force the market makers and the rest of the market to adjust and push prices up, it's a real thing. However, the crashes that follow are real too. And OnTrack had that crash. I'm not saying that Tesla's going to drop 50% or 60% or 70%, but it could. All that would do is drive it down to fair value or some notion of fair value. It's all hopped up on calls right now and leverage. And following a thread on Reddit this morning as I watched my Bloomberg and drank my tea, and it's about them talking about margin rates. And they just have no clue. They don't understand why Interactive Brokers is 2% and Fidelity's 8% and things like that. And they all have their opinions of, well, certain brokers are just trying to take advantage of you. So I chimed in. I said, I remember when margin rates were between 15 and 25%, and nobody thought anything of it. There is a lot of naivete among the millennial investors, and who I would compare it to would be the boomers in the 90s, right? The boomers who were getting in on the dot-com boom at 30-something years old, 40-something years old, had no idea what a spike and a crash was like until they had to feel it out. And then they somehow did it again 8 years later. These parabolic spikes are probably more extreme now because of the indexing. People just indiscriminately buying stocks via their S&P 500 fund or whatever they're buying. But when they come down, they're going to come down hard. Might be in stages, in waves, whatever you want to call it. I believe there were 9 waterfalls during the financial crisis, if I remember correctly. So the Elliott wave guys would say, well, that's really just 3 waves, but 3 waves within each wave. Whatever. Sentiment changes and liquidity tightens. So it's not sentiment speaking, it's liquidity speaking. Sentiment listens. That'll be the article I put out this week that should drive Avi nuts. Liquidity speaks, sentiment listens. In any case, some of our other stocks, Opendoor. Jim Chanos is bearish on that whole iBuying model. I'm not. I think it's a great model. I think it has to be managed very well. So if you're a home flipper, if you've ever flipped any homes, then you know that you have to budget right. You have to know, okay, this is how much this is going to cost me really at the end. And this is what I can sell it for at the end, give or take. And Opendoor has done a much better job of that than Zillow. Zillow dropped out. So in a home buyer's market of whatever it is, 7 or 8 million homes per year change ads, and there was more last year. Think about what Opendoor can do with $9 billion to spend if they manage their business well. So you have to put a lot of faith in Opendoor's management, number one, and understand there's a lot of doubters out there too. So the stock price is going to be volatile. We've seen it go from 19 to 24 to 19 to 23, right? In 2 weeks. So with Opendoor, you should expect more volatility. And I don't know that you can have a gigantic bet on it, because what if management fails? But here's what I would do if I were the CEO. I would take it easy on buying the houses that you just expect to flip 30 days out, because that's not where your biggest money is. And over the winter, you have some risk because fewer people buy over the winter. And they did. They slowed down their purchasing of properties. Was it 2 months ago they did that? But they still have this big store of money that they can dip into to buy whatever they want. $9 billion. That was 9 times more than what Zillow was going to do. So let's suppose Property values dip a little bit over the winter, 1%, 2%, whatever the case might be. They go out and buy some, and then they flip them in the spring after prices go back up 1 or 2%. But what if they're even smarter than that, and they identify 20 or 30 gentrifying areas within the country? They focus on those 20 to 30 gentrifying areas. They say, hey, let's buy around the edges of that, get a team in each city, and actually do a little bit more rehab. Buy these properties cheap from people who just want to get out, maybe half a mile away from the gentrifying area, a quarter mile. Then as that area comes to us because we're fixing up these properties, you'll fill in the gaps. Private people will fill in the gaps. That's how neighborhoods expand, gentrify. See it in Brooklyn. I see it in Milwaukee. They could do that. That's bigger money, bigger margins. And they could start renting out homes rather than selling them. So some of the homes are in pretty good areas and in good school districts, but maybe wouldn't sell for the biggest price. So if they can get some of these cheap enough, fix them up a little bit, furnish them, rent them out to people who have to be in town for a year or two because of a job, or in transition, they came in here and said, hey, I'm not ready to buy yet. Let me rent something for a year. It'd be very easy for Opendoor to become a REIT, spin off a REIT, or just have a rental, right? Just have a rental aspect to it. So I like Opendoor because of the flexibility. It's a huge market. They're consolidating a space that is ripe for consolidation, and they have the war chest to do it. I think their management is smart. So I don't think they have a lot going against them other than the potential for humans to stink at what they do. I did whittle it down to a 1% position today, and I don't think that's a bad idea just because their earnings are coming up. And I think that volatility is volatility. I'm trading it just a little bit more right now because I'm afraid of the Fed. Remember, don't fight the Fed. Well, I fought it a little bit on the way up. I'm not going to fight it on the way down. Fast acquisition, probably my favorite stock to buy right now. Remember, they did a deal by selling Golden Nugget Online to DraftKings, and that made a Fast Acquisition the owner of, I think it was 10 or 11 million shares of DraftKings. DraftKings got dinged a little bit the other day. Fast Acquisition has just been chopping along that 12.50 range for what, 2-3 months? I really like this company. Here's why. I think the only reason it hasn't surged is because it's not got its regular ticker yet, and that's going to happen the next month or two. If you want to know the history, here it is. Tillman Fertitta wanted to buy Caesars a couple of years ago, and he wasn't able to do it. He basically got outbid by El Dorado. So Fertitta has ambitions to become a gigantic player in Las Vegas. He did a deal with DraftKings. Who else did? MGM. So Caesars and MGM are the two biggest players out there. And they're both on the Strip exclusively. Where's the Golden Nugget? Golden Nugget's downtown. So if Caesars is out of the question now, what about MGM? MGM just unloaded its stake in MGM Properties when MGM Properties was sold to Vici. So MGM is a very asset-light casino operation now. And they did a deal with DraftKings as well. So MGM and Golden Nugget, Fast Acquisition, have deals with DraftKings. I wouldn't be surprised to see MGM and Fast Acquisition Corp merge, or if it's after the name change, whatever it's going to be called. I think it's just going to be Fertitta Gaming. I just think this is a deal that's waiting to happen. I don't know the personalities on the MGM side. I do know that Fertitta is a hard-driving guy, but he gets things done. So I could see this acquisition happening one way or the other. Either MGM buys this and Fertitta becomes the CEO. That's what he wants. I mean, he won't do a deal where he's not in charge. But I could see this happening. I think MGM is ripe to go. And this would be a pretty big deal because MGM doesn't have a lot of casinos around the country, but Golden Nugget does. So between the Golden Nugget and MGM properties nationally, and then what they'd have in Vegas, which would be on the Strip, and then the Golden Nugget properties downtown, it's got 3 casinos downtown, I think. 2? Maybe 2. It's a deal that makes sense to happen. We'll see. At $12.50 a share, you have like zero risk. Honest to God, I mean, the value of the DraftKings shares and the restaurants and the Golden Nugget and the gaming are way, way, way more than $12.50 a share. So I think that once they get their regular symbol, I think it jumps up to 17, 18, 19 pretty quick, 20. So I really want you to get a position in fast now. If you don't already have it, I wouldn't bother selling the puts anymore. Just get up to a full position because this might be a pretty easy double for you. All right, Pfizer, it popped off of their COVID pill. I still think the main story there is their mRNA platform. They're going to be able to do all sorts of things with that over the years. I wouldn't sell the pop on Pfizer if you're a dividend investor. Just deal with the volatility by holding on to it, collecting your dividend, and at some point, Pfizer is going to be a $100 stock 3, 4, 5, 6, 7 years out. It's not going to go up fast, but it's going to get there because the mRNA platform that really only them and a few other companies have of any consequence, and Pfizer has all that money to hire the right people to work it. I just don't think that you can go wrong with Pfizer. If you're a trader, could you trade the pop? Yeah, I guess, if that was your intent all along. But if you were thinking of it as a buy and hold thing, and then you're like, oh, I should trim some because it went up. No. Either go into a position as an investor or trader. Don't change midstream. You know what happens when you do that? You drown. So know yourself. Know what you're trying to do. Pfizer, if you had it put to you recently or you bought some when I talked about it, just hold on if you're an investor. 3 energy stocks that I'll cover today. Ametis, right? They have earnings in a couple days. I hope you have puts expiring on this one like I do. I hope that you have a starter position, which I don't. I just kept selling puts and never got any put to me. But carbon capture and recycling carbon into fuels are a big deal. Think about what that means. If you can take the carbon that you've captured and turn it into fuel and then sequester the rest of it, is that not exactly what we need right now? The laws are changing that you have to have less carbon footprint. And by the way, these guys make all kinds of money on the carbon credits. I don't know how much they can make on the carbon credits, but my experience with it with some guys in Europe is that it's a lot. I think Ametis could be a big company. Remember, what they're doing in California isn't small potatoes. It's still the 13th biggest economy in the world. So what if they became, I don't know, a top 20 energy company? They'd end up on the S&P 500. That means a $10 billion market cap at least. Right now, their market cap is under $1 billion. I'm telling you, this is a stock that can 10x from here, even though it's already doubled for us. Buy the dips on this one. It's going to be volatile, so you can trim your puts if you want, just to reduce your exposure a little. I have 2 batches. I have $15 puts expiring in January, and I have 1750s expiring next Friday. Those are the ones I trimmed. I trimmed the 1750s for next Friday just in case the earnings are bad, or they have a hiccup of some sort. I think that Delta contract is the harbinger. It's the whistle in the wind. The fact that Delta came to them and said, give us jet fuel, Yeah, that's a big deal. This company's going to grow a lot. 3 billion, 4 billion, 5 billion. I think they're going to end up on the S&P 500. It's under 10 billion. It's under $1 billion right now. It's got a 10x, more than 10x to end up on the S&P 500. It's going to end up bigger than most of those frackers out there that are shrinking. New Fortress Energy, right? They're in LNG. They have something called fast LNG. Remember I showed you the pictures of that ship that was an LNG processing and loading vehicle, right? They didn't have to build something on shore and get a bunch of trains. They just float it on over to the well, turn it into LNG, pump it into a freighter, ship it off to whoever ordered it. That's huge business. Think about all the flaring that goes on, all the gas that just gets thrown out into the air. These guys, again, they're on the right side of history. They're helping reduce carbon into the atmosphere, and they're turning it into energy. Another one that's going to be volatile, but you can buy it on the dips. And SunPower, their earnings were okay last week, but as we have learned, residential adoption of solar is slow. Mainly happens with new constructions, which we know there's going to be a lot of this decade because we're 3 to 6 million homes behind. But again, another one that's going to be very, very volatile. So you got to keep track of it. Look for spots to get it. All three of these stocks can be 10 baggers. All three of these companies are on the right side of the energy transition over the next 10 years, not the wrong side. So when people tell me in the chat room that they own an oil pipeline company, yeah, I can't be mad at them, but all I can say is, look, it's a declining business. It's declining over a long period of time, but it's declining. And at some point, it's going to be an upside down hockey stick. You know, the folks who tell me that oil demand growth is still growing, like, it hasn't grown at more than 1% in a year forever, for a decade. And you can't really count the rebound off the bottom from coronavirus. You got to take the point from 2019 to the point to 2021 and say, okay, what was that? 1%. And we have a mountain of lithium coming online for mines in 2024, 25, maybe even by 2023 if they get ahead of schedule, which they're trying to do. Everything is converging on a massive, massive shock to oil in the next several years. 26, 27, right in there. All the EVs being sold, more and more natural gas getting to market by carbon capture. Pretty interesting system. I'm writing a big report on it. I'm hoping to have it out by the end of the year. I'm thinking about turning it into a self-published book. We'll see. Somebody asked about Pfizer versus Moderna. I like Pfizer a lot more. They have a deeper bench of talent and they have a lot more money. Moderna is more of a pure play. I like the diversification of Pfizer. And as I've told you, you know, Moderna got pumped up pretty hard. So I would, depending on what your game plan is, I probably favor Pfizer a lot more. Moderna's $240. Yeah, I mean, I think Moderna is probably fairly valued. And I think that Pfizer's probably undervalued. So definitely no hate on Moderna. I just, you know, the easy money was made there, and they don't pay a dividend. So I think you get a little bit more safety and an income out of Pfizer, plus probably a little bit more upside because of the deeper product bench. It doesn't hurt to own both, though, especially if you don't need the income. And you can always just keep selling puts and calls on Moderna. Somebody asked about the fast acquisition. When do I have to split off the units if I own FSTU? You don't. You don't have to do anything. When the symbol changes, they'll give you warrants. That's how that works. Back to Pfizer and Moderna. Somebody asked if there's legacy issues with Pfizer. Well, I guess. I mean, look, in this country, we don't allow the big guys to get sued, right? They only pay out what they feel like paying out. I mean, it's wrong, but it is what it is. And I don't know that there's anything Pfizer has out there. I mean, J&J just got out of a couple of things, and they were pretty guilty. So, who knows? I don't know if there's anything out there with Pfizer floating around. I just don't know. But my general idea on American pharmaceuticals and giant companies in general is once they become big employers and they're able to buy lobbyists, it's pretty rare that anything consequential ever happens to them. The fines are just part of the business, right? Lawsuits and fines are just part of the business. It's just a cost that you absorb. All right. I will look to see if there's any puts I want to sell. Fast acquisition would have been one of them, but it's really just, it's my only limit order. I have another order in at 12, but I might just stop screwing around and just buy it. So it's up to you how you do it, but I'm trying to get to 4% on fast acquisition. I don't think there's a lot of risk, and I think the upside is pretty big, to be honest with you. I think it's another one that, if it merges with MGM, I mean, no telling what can happen then. I mean, it could be a to the moon sort of thing. I'm surprised that MGM hasn't gone up faster. I think a lot of it has to do with COVID yet. So to the extent that you can buy the dips on these gambling stocks in the next year, next year could be a lot like 2018 is how it's shaping up. So let's see. But if you get chances to buy these gambling stocks cheap, buy them. Because, as I talked about in the Friday webinar, all the Fed is doing is reloading their bazooka. That's all they're doing. If you look at the curve for the treasuries, over last year, we pushed out maturities on treasuries. So that means that we have a few years before we have to do it again. So the next 3 years or so, all the Fed has to do is short-term buying. So all they have to do is to keep the short end of the curve low. It doesn't matter if the 10-year goes up to 3% because they don't have to buy it. But when they need to start refinancing American debt again, there'll be a reason for the long end of the curve to drop. Then all of a sudden it'll go from 3 to 2 to 1.5 again. Oh, and now the Fed's going to buy it because it's 1.5. It's a game. The game. All they're doing is trying to figure out a way to massage American debt and the business cycle until we don't have such massive deflationary forces facing us. Without the rise in energy prices, there'd be no inflation. You need to keep that in mind. Without higher energy prices, there would be no inflation right now. It's a fact. I showed you the chart. Energy prices went up 25%, and that pulled regular inflation up to about 5%. And then idiots called that hyperinflation. Well, with energy prices at the level they're up now, they really don't have a lot of upside left. So year over year, right, because you do your prior year comp, I'm telling you, by this time next year, the inflation rate is going to be 2% again. And then what are people going to think? Is that good or bad? Well, if they all got jobs at higher wages, that's good. And that's what the Democrats are trying to engineer. I don't think they have a good way of explaining it because it gets all tied up in gobbledygook, political speak. I've never understood why they don't just tell us what they're trying to do. Hey, we're trying to get everybody higher wages and then have the price of the stuff you buy not go up anymore. Well, that sounds pretty good. You can give me a raise and nothing else is going to go up down the road. I like that. So we'll see. All right. Have a wonderful day. Weird thing with my daughter's pregnancy yesterday. They tried to induce her. They gave her 3 shots or whatever it is they give them. And by 7 o'clock at night, they were like, wow, this doesn't look like it's going to happen. Do you want to stay here overnight or do you want to go home? And she says, well, I'm going to go home because you guys are driving me nuts and I don't want to hear all the beeping. So she went home. And they said, you know, go see your doctor on Tuesday and figure it out from there. So who knows? Someday this week, I'll probably be a 2-time grandfather. You know, we're the over and under is a Tuesday night. I mean, that's the betting line that I put out, but we'll see. It could end up being Wednesday or Thursday. It could even be by next weekend. Who knows? Sometime next week. All right. Have a wonderful day, and I will get this published. I want to go through about 10 more companies' notes. In case you've never seen one of the things I set up something called an edge report with Sentio. So it helps, you know, gives me a whole list of things to take a look at. It's a nice setup. All right. Take care. I will get this out to you the next hour or two.